Hi there. In this month's E.M.I, as usual, we make a number of observations. We dig into why the Japanese yen witnessed a sharp appreciation in July. We noticed that urban indicators saw passenger cars and MUV sales holding up. Geopolitical uncertainties continued, US-Iran tensions flared up, global semiconductors witnessed a sell-off, and FIIs made a strong India return end of the month. We take a quick peek into global domestic returns, flows, earnings yield versus bond yield, and much more. On investing, we ask how many years does it take portfolios to double in size? We also calculate how many times do portfolios double over an 18-year time horizon. The Japanese yen saw its fourth snap in 2026. We wrote about how something shifted in the markets around the yen in our November 2025 presentation. We flagged that the yen carry risk had become increasingly asymmetric with narrowing spreads, elevated shorts, and a well-known trigger at yen 160 to the dollar. In other words, we said that there was a limited upside and a large downside for those shorting the yen as a currency. Despite this asymmetric risks, markets have been continually rebuilding their shorts since November 2025, and we have witnessed three sharp phases of appreciation in the yen, with last month being the fourth phase where the yen snapped. Remember that a month before, in June 2026, the short build-up in the yen touched a 9-year high. The most important point to acknowledge is that intervention only addresses the symptom. The structural reason remains the positive gap between US and Japanese policy rates. Another reason is the Bank of Japan artificially keeping yields lower through continued buying, keeping spreads elevated. Whether the US's strong joint intervention changes the costs of the yen carry is the open question for markets. Let us now take a quick look at how some key short frequency macro indicators look like. PMI indices moderated and CPI inflation saw a continued rural bias. Urban unemployment improved alongside an uptick in e-way bills. Urban indicators saw passenger cars and MUV sales holding up. S&P 500 moved lower while Nifty 50 witnessed an appreciable uptick. Let us now shift to the markets. Before we look at returns and valuations, let's see how the Nifty performed in July. Hong Kong, Singapore, Brazil outperformed key equity markets in July in US dollar terms. On a 12-month basis, South Korea continued to top returns. India saw a pickup on a 1-month basis. July equity returns were well below historical averages. India July net equity inflows were in the positive, were next only to Japan. FIIs added healthcare, financial services on a 3-month basis. Outflows were seen from oil and gas and power. IT, media, realty top outperformance in July, while energy, banks were underperformers. India valuations were seen well above peers, just below Japan and the United States. Valuations remained mixed in June with a marginal small cap pickup. Nifty earnings yield bond yield gap remains just below its long-term average. What must you know before investing? How many years does it take portfolios to double in size? At 12% CAGR, money has taken 6.12 years to double. How does one read this chart? Now, each bar in this chart shows the number of years a lump sum needs to double at the respective annual return. At 4% CAGR, money takes nearly 18 years to double. But at 12% CAGR, doubling takes place in just over 6 years. Time taken to double falls sharply between 4% and 10% interest rates. You can also arrive at the time taken to double by using the rule of 72, which is 72 divided by the rate of return. At 12% CAGR, money grows 3.8x more than 4% CAGR. This chart shows what a rupees 10 lakh investment grows into at a specific interest rate. Why are we taking 18-year periods? The 18-year period is used as a comparison. This is the time it takes a 4% investment to double. At 4%, rupees 10 lakhs grows into and just over doubles to rupees 20.5 lakhs. Compare that with an investment at 12% CAGR that grows to rupees 76.9 lakhs. In short, the same 18-year time frame that grows 4% returns by 2x grows 12% returns by nearly 8x. How many times do portfolios double over an 18-year time horizon? At 12% CAGR, money doubles 2.9 times. This chart depicts the number of doublings a lump sum investment completes over an 18-year time frame. While investment growing at 4% doubles just once in 18 years, 12% doubles 2.9 times and 15% doubles 3.6 times. Remember that this is the number of times the investment doubles. So while one time doubling turns 4% investment of rupees 10 lakhs into just over 20 lakhs, 2.9 times doubling turns 12% investment of 10 lakhs into 76.9 lakhs. Therefore, the difference between 1 and 2.9 times doubling is the difference of growing your money between 2x its size and roughly 8x its size. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.